So the stock market's down a little bit on this Monday as of this broadcast, but we have seen some interesting dynamics playing out in the markets. Let's talk a little bit about what we have been noticing with Phil van Doorn, investing columnist and analyst at MarketWatch, who rejoins us here on Jimmy at the Crossroads. Brother Phil, welcome back. Good to have you, sir.
Good morning, Jimmy. Media personality. I like that.
Yes. Well, hey, happy Star Wars Day. May the 4th be with you. Do you like Star Wars, Phil, or are you a loser?
I enjoyed the first two movies especially, and I have fond memories of seeing the second movie twice. I guess it was 1980.
Sure.
Jedi was a little bit of a letdown, but I thought that the prequel trilogy was silly. It just didn't work.
So as long as you like some of the Star Wars movies, I will accept the criticism of the prequels and also the sequels. But I grew up on the prequels, so I'm rather fond of
I can tell you something, though.
Yeah.
Here's what you did not experience. When we're waiting 3 years for a new Star Wars movie to come out between 1977 and 1980, when you walked into the theater for The Empire Strikes Back, you have the most incredible music playing on the most incredible sound systems. And for 2 hours, you're seeing images that you could not see on television.
Right.
Television was low resolution. There were a few sci-fi movies out there, but you had no chance of seeing anything like what you could see in the theater now. These days, life's a little bit different. You see beautiful images right on the television.
No, that's a good point, Phil.
You weren't there. You can't tell how exotic it was.
Well, in the first movie, seeing that in 1977, did you see that one in theaters? The original?
No, I watched that at my aunt's house.
So the first one, anybody who I have talked with who has seen the first one in theaters has said it was just a remarkable experience because nothing ever like that had been on screen before.
Yeah, and that's what I experienced with the second movie in the theater. I didn't see the first one in the theaters until they were remastered in the 1990s.
Yeah,
when they did a lot of simultaneous food issues with at McDonald's, you can get some pretty cool Star Wars toys. Wow. I suppose in 93 or 94. Maybe it was 94. I cannot remember what year it was.
So
but I did get this.
It was
remarkable cube toy from McDonald's.
I think it was 96 or so because I saw at least a couple of them in theaters when the special editions did their runs in theaters when I was a kid. So in the 90s, I remember going to the movie theaters to see that.
Yeah.
So I just love it. Yeah.
It was a little disconcerting because some of the effects that he added to the first one did not look proper in the theater. They looked pasted on.
I don't recall that,
okay.
But I believe you. I can understand some of that. But, it is Star Wars Day, so we were talking a little bit about some of the lessons we can learn from Star Wars. Yes, because it's May the 4th. May the 4th be with you. So, exactly, it's Star Wars Day. I mean, that's exactly it. So, is this a revelation to you? Did you not realize that today is Star Wars Day, Phil?
Since you said May the 4th be with you,
yes.
When you're in the mood for something that's a little bit funky, you can look up on YouTube Thomas Dolby, May the Cube be with you.
Okay. Don't tell me
more.
That's
something I know. You can't play it on the show now, I suppose, but you can listen to it later. It's a nice piece of music.
I will check it out.
But it is not blues.
Yeah, fair enough. Gosh darn it. Maybe I'll do a bluesified version of May the Cube be with you. I don't know what the song is. I got to listen to it first. Phil van Doorn, investing columnist and analyst at MarketWatch. Let's jump into some serious topics at the moment. The market's been just a fascinating thing in the last couple of months with the ebb and flow. We've seen bad economic data, yet the market's been performing relatively well. Right now, we're seeing sort of a mixed bag as of this broadcast, slightly up on the NASDAQ, slightly down on the S&P and the Dow Jones Industrial Average, just day-to-day stuff. What do you think is going on overall in the market right now, Phil?
I don't know what's going on, but I do know what people need to do.
I didn't say no. I said think. What do you think is going on?
I think the market is being supported by an incredible amount of cash that is available to investors. So the cash needs a home. The stock market is a lot smaller than the debt market. and the debt market is not very attractive. It depends where you're looking, of course. There are a lot of interesting opportunities in high yield debt with some pretty bonds. But in the world of equities, we've seen a faster recovery than we've seen in previous crises because the Federal Reserve and the federal government have acted so quickly simultaneously. There's so many different programs and there's so much money out there supporting stocks. But what I think is worth pointing out is that the market, if you look back 12 months, yes, the Dow Jones Industrial Average is down 11%, but the S&P 500 is down 3%, excluding dividends. That means it's pretty much flat if you include the dividends. What this means is that you have to think about your mindset in the third week of March when the market was down. You may have said to yourself, I should have sold my stocks 2 weeks ago or a month ago, and then I would have avoided all this pain right now. If you were thinking that at the bottom, you should sell now because you're looking forward to horrible economic reports coming out in July. So if you're worried day to day about the stock market, this is
Phil van Doorn, our guest
away from
from
stocks.
MarketWatch. You cut in and out for just a second there, Phil. Can you say the last 15
I'm so
seconds
sorry.
again?
My point is that if you cannot handle a down market, this is an opportunity for you to get out and rebuild your portfolio, diversified at least in part away from stocks. If you're a 401k investor with many decades to go, when the market crashes, you're paying lower prices as you pour money in every paycheck. But if that's not you, it's time to explore different possibilities because the market essentially is flat from a year ago.
So, since you mentioned dividends a moment ago, let's talk for a moment about 9 stocks. You have a new story up today about 9 stocks that face dividend cut risks. What are those? What's happening?
I spoke to a gentleman named Rob Spivey, who is one of the 2 founders of a company called Valens Research. This is an independent financial research company. They sell data and reports and recommendations to investors. Unlike the Wall Street analysts, which work for brokerage firms who are also trying to sell stocks, these guys are free to be completely independent. And what they do is they make a bundle of changes to the reported numbers for 32,000 companies. They have a large staff working on this. They try to blow past all the noise and all the inaccuracies in the financial statements to tell you what's really going on. So they put up a list. It's one of their short ideas lists of stocks that they think are at high risk for dividend cuts. One thing that consider, you might look at a company with a high debt ratio and say, these guys are in trouble. But that doesn't tell you when the by the Valens teams, and they look out over the next couple of years. If a company does not have sufficient cash to pay off bonds that are coming due, and the debt market is disrupted again, you may have to cut dividends in order to support your cash flow. So they listed 9 familiar companies, and you should check it out. I can read off the list if you like.
Yeah, again, Phil van Doorn is our guest here. He's investing columnist and analyst at MarketWatch. Phil, please go through the whole list and then maybe pull out 1 or 2 companies that are particular standouts on the list as being especially interesting.
Okay, the list, there's in no particular order. Deere and Company, that makes John Deere equipment. General Mills, which makes dog food. General Dynamics Corporation, Conagra Brands, Newell, Kraft Heinz, Kellogg, more dog food. Campbell Soup Company, and Sealed Air Corporation.
I like dog food, man.
Well, cereal is dog food made by dog food companies, but that's a different subject for a different day. All of these companies have debt coming due over the next couple of years, which could lead to dividend cuts if they're forced to shore up cash. What if the market changes so that they would be paying too much to refinance? Then other things will be on the table. Company General Mills, for example, they bought a company called Blue Buffalo in 2008 for $8 billion. In 2018 for $8 billion, and they issued $6 billion in debt to help pay for it. Now it's faced with a constant flow of maturing bonds over the next few years. So if we have a lockup in the credit markets, which is possible over the next year, they may have to cut their dividends. You have specific risks for specific companies. Like Conagra Brands has a lot of food service and restaurant customers. So they also have debt maturities and the threat to cash flow, which may lead to a dividend cut. So that's pretty much the theme on all of these. Kraft Heinz has already cut their dividend, and they, according to the Valence team, their cash flow is not sufficient to cover their upcoming debt obligations. So they may have to tweak things, which includes cutting the dividend. So the article has some comments from them about each one, and the theme is, while they're in different industries, the theme is pretty much the same.
Now, I do have to say that in terms of cereal, because my mind is on cereal now, Phil. I mean, I like Kellogg and General Mills cereal, but I was going through old memorabilia boxes last night or yesterday doing some organizing in my parents' house of old boxes, and I found a box of Star Wars stuff that includes several empty boxes of Star Wars cereal from when Episode 3 in particular was coming out in, 2005. So, by the way, there was a period of time where Star Wars movies were still coming out every 3 years, even in my lifetime. So let's just keep that in perspective. Phil van Doorn, again, our guest from MarketWatch. Let's talk a little bit about this strategy. I have another story that was up over the weekend about buying the fastest growing businesses in America. There's a particular investor who's been using this strategy for 2020, has been successful so far. People are always looking for what are ways in which to be successful, including during this climate. Who'd you write about, and what was his strategy that was so successful so far?
Gentleman named Gerald Sparrow. He's an investment advisor. His company is called Sparrow Capital Management. They're based in St. Louis. This is a one-man shop, although he has a few people working for him, but it's pretty much him by himself. And he does not only look at sales, because sales in dollars can be spiked in different industries because of one-time events. He looks at unit sales. So he tries to identify, he looks at all of the publicly traded companies, small to large cap in the United States, looks at the fastest sales growers, then digs into unit sales to make sure sales don't pay. And he holds about 100 stocks. If a company's growth rate slows down, he sells. If a company's growth rate remains within the top 100, he keeps it. It's just that simple, and it's worked out beautifully for him. He started with this strategy, a switch-in strategy, at the end of 2016, and there's a chart in the story that is incredible. So he's performed very, very well, outperformed the indexes, and it was not only during the down market this year, it was through the late stages of the bull market. So I'm impressed. It's a different approach. Normally, a manager who outperforms an index will be concentrated, holding 20 or 30 stocks, so that his good bets have outsized influence to help him beat the market. But this gentleman has a completely different approach.
This particular piece is a strategy of buying the fastest growing businesses in America has paid off for this investor in 2020. Phil, throw another story at me, something else that over the last several days has been of particular interest to you.
Oh, Jimmy, you're putting me on the spot
That's
here.
exactly right. I wanted to ask you a broad question, give you a little room to choose a story that you like and want to talk about.
Well, I see a story. It's not necessarily that I like it, but I've been interested to see the story being played from different angles, which is the notion that the coronavirus may have been accidentally spilled out of a research laboratory in Wuhan, China.
Yeah.
That's interesting. Now, the Post was covering it, the New York Post, that is, was covering it over the weekend with quotes from Secretary of State Pompeo about the evidence. Then you had some quotes from President Trump. Story was either buried or not covered by the New York Times until, I believe, yesterday, when they started saying that multiple voices around the world were clamoring for investigations and maybe action against China's communist government. And I found it fascinating. When you get when you have media voices on the left and the right pointing in the same direction, you have something with legs.
Phil van Doorn, I think that it is true, and we've on this program, I've said, I personally, that I'm convinced enough that that is the case, that it was. I mean, it hasn't been absolutely verified with certainty, but I think that there is enough support to suggest that accidentally, perhaps, but still came from a lab at the Wuhan Virology Institute in Wuhan, China. I mean, I think that's the case. And just since you mentioned this, pull up cut 7, Nathan Matoush, because I just want to play real quick so folks can hear. Yesterday, Secretary of State Mike Pompeo, who you mentioned, was on the Sunday shows on ABC News this week, and he had this to say about China and why he believes China hid COVID-19 from the world.
I want to turn to China with intelligence officials, as we mentioned, saying that the Chinese government intentionally concealed the severity of COVID-19 from the international community in early January while it stockpiled medical supplies. In terms of international concealing, I assume you think they did that intentionally to keep as many masks for themselves as possible. Will there be some sort of retaliation?
So, Martha, you've got the facts just about right. We can confirm that the Chinese Communist Party did all that it could to make sure that the world didn't learn in a timely fashion about what was taking place. There's lots of evidence of that. Some of it you can see in public, right? We've seen announcements. We've seen the fact that they kicked journalists out. We saw the fact that those who were trying to report on this, medical professionals inside of China, were silenced. They shut down reporting. All the kind of things that authoritarian regimes do. It's the way communist parties operate. This is classic communist disinformation effort. That created enormous risk, and now you can see hundreds of thousands of people around the world, tens of thousands in the United States have been armed. President Trump is very clear. We're going to hold those responsible accountable, and we'll do so on a timeline that is our own.
Makes sense that countries around the world would be deeply concerned about China, Phil.
And some people, sitting behind their desks or on their couches may oversimplify this. You do not instantly redirect all of your supply chains from China.
Yes.
Because it took decades for the current situation to be created. Apple, for example, indirectly through Foxconn, employs millions of people in China assembling iPhones. They cannot instantly move that production. But companies can start making slow changes. Why not? Why not open some factories here in the United States? I think at this point, people will be ready to pay some higher prices for products that are assembled here. There are also countries that are outside, closer than China. There are all sorts of different things that can be considered. You could also reconsider the required technology transfers that have been made to China over the last couple of decades by U.S. and Western manufacturers. Put everything on the table and try to come up with better supply chains. And Congress can do certain things. For example, they can mandate that American companies manufacture certain critically important personal protection items here.
I have mixed feelings about the idea of, actually not very mixed feelings. I'm not a big fan of mandating production of anything in a particular country, but your point's still well taken. I think the one that I particularly
You don't have to do that, but you could mandate that it's produced outside of China. There's tweaking that can be done.
Sure.
Why are we beholden to a country that considers itself our enemy for these critical items?
Fair enough.
We've also seen the behavior of China's communist government with their aggressive behavior in the South China Sea, waters that are considered international waters by every other country.
Fair enough. No, I understand.
At this time,
I think that I could be more open to, but we'd have to particular materials and what have you. But what I think needs to be done more than anything to incentivize production, particularly here in the United States, is significant reductions in regulatory costs and regulatory burdens. We're learning in this crisis that government is getting in the way in so many places, and notwithstanding what I was saying before, before about the concentration of government authority, we're also seeing a lot of governors and the president cutting through the red tape on a temporary basis. They should make it permanent, especially when it comes to manufacturing goods. Then you provide a real monetary and economic incentive without any sort of mandate being necessary. But Phil van Doorn, I have one more question for you, just because every time I have you on, I like reminding people about this. Tell us your feelings on how people should interpret headlines when making investing decisions.
You could have just stopped with how people interpret headlines.
Okay.
And I could go off about
Fair.
how
That works too.
So much of printed news is nothing but, because after the headline and maybe one sentence of new information, it's all a rehash of the previous day's article. So sometimes people are reading newspapers or reading articles online and actually allowing their brains to wither as they get no new information except for the topic sentence. So watch out for that. Otherwise, as far as investing for the headline goes, I don't know what to tell you about it. Maybe that's good for day traders. It's not good for a real long-term investor.
Definitely. No, for sure. And I think it's always an important question to just stress, hence why I like asking you. And you always give a slightly different answer, but with the same fundamental point.
That's because I can't remember what I said last time.
Well, exactly.
So
of course,
a career in politics wouldn't work.
But at the same time, you get to the essence of the right point, which is don't just follow along with the headlines and then make your decision. You got to look a little deeper than that. I saw a story last week from the Wall Street Journal talking about how social distancing could be this generation's GDP. And I read the story and I was like, the story was interesting.
That doesn't make sense.
That headline doesn't make sense, and it was ridiculous. I was scratching my head wondering what exactly is going on here. I just don't get it.
It's search engine optimization.
Yeah,
you just
sure.
got social distancing and GDP in the same headline. You could have gone more arbitrary. They're trying to at certain media outlets, they're reducing COVID-19 and coronavirus appearances in headlines because some advertisers don't want their stuff anywhere near those words on the page.
Sure. All right. Well, Phil van Doorn, always an interesting and fun conversation to have with you.
Thank you, Jamie.
I hope you have a good week. Good to have you back here on the show. Investing columnist and analyst at MarketWatch, Phil van Doorn.
Thanks, Jimmy. And remember, please don't offend anybody with your humorous videos. Please keep everything clean and politically correct.
Yes. Well, I didn't want to offend you. I hope I didn't offend you, my friend, but may the 4th be with you.
You got it, brother. Enjoy. All the best.
All right, you too. Again, Phil van Doorn joining us for MarketWatch. Always great to have that guy on. You gotta love a good conversation with Phil. You just watched a clip from Jimmy at the Crossroads. Don't miss more engaging, intelligent talk. Subscribe to the Jimmy at the Crossroads YouTube channel today. You want to catch our live show. And I love your support.
I got Jimmy at the crossroads, making sense out of no sense. Yeah. Awesome.